Alright, guys, I am back. I apologize, I haven't been making videos, but actually very busy lately. Been going through something too, so now I have a couple minutes of break here before I have to go back, take some courses here for work and stuff. But today I just had to make video about GameStop, right? Now, yesterday would have been a perfect day to make it, but I just didn't have the energy to do that. It's been a tough week, to say the least. But anyway, so let's try to do this as quickly as possible, and let's jump into it. Now, I'm sure you've already familiar with the number for today, right? For yesterday earning, which came out amazing. Now, if you worry about the price action, man, like if you get GameStop under $22, which is the price that Ryan Cohen bought in with $10 million of his money, then I don't know why you're complaining. You're buying at a price point where it's cheaper than the actual executive that is in the company right now, right? It's like, man, count it as a blessing to see it's down like this. But anyway, let me go through the number real quick. So $1.16 million in sale, up about 2% in sale when everybody is going down. And mind you too, this is the second quarter. The second quarter is usually the worst quarter for GameStop historically, right? So they beat the estimate by miles, right? Now, let's see what else. They were able to lower the cost, right? Cost of revenue, meaning cut down the amount of money that being used in order to make money, right? So in turns, they have increased the gross profit for this company, right? And then on top of that, the operating expenses went down by about $22 million or so. This is amazing, right? Now, unfortunately, they come at a loss still. But look at how the amount of loss that they incurred for this past 3 months. $2.8 million. Wow. That is like enormous. That is huge loss. No, I'm kidding. That is like nothing. Nothing at all. But anyway, so let me go down more here. So, and this is the most important too, right? When it comes to like people trying to evaluate the company and all that stuff, what is their profit margin? Now it's increased to 26% profit margin. In the past, it was like 16, 22, 24. You know why? I mean, even the best quarter right here, which is quarter 4, right? 22%. So in their worst quarter ever, they were able to generate more profit margin. Hey, if you're complaining about the price being low with this type of balance sheet, then you are a complete, I don't know, just fill in the blank for me, right? Now, let's go here too. So on the balance sheet, I'll show you in a minute a more comprehensive one, but I'll go through it later on this week. But yeah, I don't want to make this video too long. So they have cash still. If you combine these two, marketable security with the cash, they have about $1.1 billion in cash still, right here. Well, 1.2. I mean, it's close enough, right? Round it off. And then the cash growth is 31%. How are you complaining about this price action? I don't know. I'm going to keep saying that because people are not getting the the message here. And then what else? Receivable went down. Now, inventory, yes, went down. That's good. We want to see that because that means they are selling their product, that it's not just sitting on the shelf. So it's still, they still have about $500 million in inventory to go through. What else? I'm looking for the debt thing, right? So long-term liability down to 35, say $36 million. Wow, that's amazing, right? That's so much debt. No, that's not. Oh, and then look at this. They were able to decrease their liability down to like, man, that's like a $200 million swing in 3 months. Okay, reduced liability. That's amazing. All right, so if you look at the total costs or total debt for this company, they were able to pay off debt, like quote unquote, right? I have to like look into what that entails, the debt, because they calculate it differently. Okay, so I'm sure that's account payable and all that stuff like is including in this total debt amount here. Okay, but as far as the debt that they have to pay immediately in the long term, it's right here. That's nothing at all, by the way. But anyway, so they're able to pay it off by 5%. That's good, meaning like, hey, at least they're servicing that. And I hesitate to call it debt too, but whatever. I'll elaborate later on. What else? Let's see. Net cash per share, positive 1.8 per share. Amazing, right? And this is cash to debt. Look, cash to debt growth, 82% increase, meaning that they were able to reduce the liability down so low that even though they have net cash position lower than last quarter, they still come out 80% increase. Right? Unless I'm analyzing this wrong, so please let me know if I did. But man, this balance sheet is solid. So let's look at the cash flow here. This is a cash flow quarterly, right? And then you got, this number already. Everything else just 0, 0, 0. And that's what we want to see, right? Look, free cash flow. Quarter 4, they were very good. And then quarter before that, so the third quarter of last year was free cash flow positive as well. So if you do the trailing, now the trailing is accounting for the 12 months, okay? If Moran's Rants was watching, if you watch Moran's Rants video, he mentioned like the T12, and this is what it is, I think. I might be wrong. But anyway, so now trailing 12 months, T12, they net loss of close to $100 million still. Like, so 12 months ago, accounting from now, 12 months ago, if you add it all together, they're still in the net loss of under $100 million. They could make it back in 2 quarters. Why? Right? But look at this. Trailing gain of cash flow, close to $400 million. So this company makes money. $400 million. That is huge, you guys. Net cash flow, they just post a net cash flow positive right here, right now, in 12 months. I mean, need I say more? And they've been positive Look at this. Free cash flow per share. I mean, it just, but anyway, here, look at the statement here. So what is the trailing free cash flow measures? It measured the amount of leftovers cash that has been generated by the company over the course of the past year. The more free cash flow a company has, the more easily it can pay its debtor and investor and reinvest it in itself. Okay, so this is good. This is good. It's more than good, but I'll just give it to them. It's good. It's amazing. It's everything that you want. But yet, this guy, one analyst, gave it at $6 per share without giving you any breakdowns why they think that or whatever. But let's look at the history of these analysts here, right? Now, Wedbush, I haven't done any research on that, but look at this. Let me compare from last year. Let's see. Any September ones? Right here. Whole. $2. $1 per share. Okay. Well, at least they increase their expectation here. $2, $3. Ridiculous, right? And then you have, back in June, they have a little bit more of optimistic here. So back in June, do you think back in June GameStop was worse off? Or now GameStop is worse off? Why did they give a higher price target then versus now? Now that might have something to do with the stock split thing. So I might have to do a little bit more research. Perhaps it's because of the stock split. That's why they immediately drop it. But nonetheless, though, all in all, this company is solid. Like, man, if you don't get that this price point is like a steal, I don't know what else to tell you. But anyway, I'll end it here. Sorry if it's long-winded. I just wanted to make a video. I'll see you later. Okay.